It goes without saying that Tesla is a fantastic trading stock, but it's also incredibly risky and can make sudden, violent moves. And if you're on the wrong side of those kinds of moves, it can cost you your account in some cases. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan. And the professional traders on our desk are well aware of the risks of an erratic trading stock like Tesla, and they've developed options trading techniques to harness the power of a stock like Tesla without taking account-wrecking risks. In today's video, we'll be sharing with you one of these strategies. So if you're interested in a way to trade Tesla that pulls most of the risk out of the trade while giving you tons of upside, then I'd stick around because I think you're going to find this fascinating. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so Tesla is obviously one of the hottest trading stocks, and as you can see from this chart, it's rallied as much as 3,500% within the last 3 years, with a split-adjusted low of 3,540 back in 2019 and an all-time high of 1,243 in the last quarter of 2021. But as the entire trading world has observed, as violently as Tesla can rally on a single day or week, it can have equally violent sell-offs, which means that there's a ton of risk being either short or long Tesla stock. In the last 12 months, Tesla has individual weeks with moves greater than 160 points, both up and down, and so flat out being long or short Tesla shares can be pretty risky business. But professional traders with a knowledge of options trading understand that there are ways of controlling these risks while maintaining a great amount of reward, and in this video, we're going to be teaching you one of those techniques. Now, before we get into the details of how this high return, low risk option strategy works, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or an index trade, even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. All right, so the example I'll be sharing with you, which incidentally is based very closely on a real trade made by one of the traders on our desk. This example involves the trading of Tesla call options. So we need to make sure that everyone watching this video understands how call options on stocks work. And this is going to be quick, so for those of you who already understand call options, just hang in there for a minute. So a call option on a stock entitles the buyer of that option to buy 100 shares of a stock at a certain price called the strike price of that call option, regardless of how high the price of the stock has gone when he exercises that right. So all other things being equal, when a stock price goes up, the price of the call option for that stock will go up, because obviously if you can buy shares of a stock that's getting more and more valuable for a fixed price, no matter how high that stock goes, that right itself starts to get more and more valuable. And if a stock price goes down, again, all other things being equal, the value of the call option will obviously go down because that right gets less valuable. And if on the day that the option expires, the stock closes below the price of that call option, then it loses all of its value because no one is going to be exercising their right to buy 100 shares of a stock at more than it's worth in the open market. Okay, so now that we're clear about how call options work, let's take a look back at a chart of Tesla for the last 6 months. And as you can see, back in November, Tesla hits its all-time high at 1243. And you can also see that by mid-December, it had sold off all the way down to 900 before recovering in the final days of December. So when on the first trading day of 2022, Tesla rallied to 1200, it wouldn't be crazy to wonder whether this was now a short, having hit the 1200 level, which has served as resistance twice before. And in fact, some of the traders here on our desk did in fact feel that Tesla was a short at that point. But remember, shorting Tesla has not exactly been a cakewalk over the last 3 years. And so it's a very dangerous time to take a short, as this could be the time it blows through resistance and takes out another leg up to who knows what level, in which case short traders would be trapped in a terrible trade. And so let's say that you had conviction that Tesla was going to sell off and that the 1200 resistance level was going to hold, but you didn't want to take the risk of Tesla bursting through resistance. So to deal with that, suppose in the afternoon of January 3rd, the first trading day of 2022, when Tesla was trading at 1183.50, you decided to find the options chain that was expiring fastest, which in this case was the Friday, January 7th options chain, which expired 4 days later. And you went ahead and bought the 1200 call, which was trading for 24.90, and you simultaneously sold the 900 call, which was trading for 283.58. And when you do that, when you buy a call at one strike price and sell one at a lower strike price, that combination is known as a call credit spread to options traders. Let's analyze what's going on here from a cash flow standpoint to understand how this trade works. And as you can see, we sold those 900 puts for 283.58. But remember, each options contract relates to 100 shares of stock. And so you multiply that price by 100. And thus, you've brought in 28,358 in cash from that sale. But you then spend some of that cash on buying the 1200 call, which cost you 24.90, as you can see from the calculation. Now, one thing that you might be wondering is, why is there such a huge price difference between the 900 call we sold and the 1200 call we bought? Well, think about it. That call that we sold represents to the buyer the right to buy Tesla at 900, which means that if the trader we sold that call to exercised his call immediately and bought from us 100 shares of Tesla at 900, because Tesla was trading at 1183 that day, he could sell those shares for 283 points higher than he just acquired them for minutes earlier. And so he'd make a profit of over $283 per share, and he'd own 100 shares. And so he would immediately make a profit of over $28,000. And so the value of that right, that options contract, is going to be approximately what he could make if he flipped those shares the next minute. And that's why you received so much money for selling that call, because it's incredibly valuable the moment you own it. And the market's not just going to give that value away to you. At the same time, the 1200 option represents the right to buy Tesla at 1200, which it hasn't even reached yet on this particular trading day. And even though there's absolutely the possibility that it will reach 1200 by expiration day 4 days later, it's not there yet. So the right to buy Tesla at 1200 certainly has some value, because for all you know, Tesla could shoot up to 1400 within 4 days, the way that stock trades. So there is some value worth paying for that right if you think Tesla is about to break through resistance. Whereas that deep in the money 900 call option immediately has value as soon as you exercise it, because they can be flipped for such a huge gain per share immediately. And so with that understanding, you can see why you received so much money for selling this call credit spread. So then you're probably asking, well, how exactly is this a bearish bet on Tesla, bouncing off of resistance? And we'll move to expiration day on January 7th so that this will become clear. And as you can see, Tesla at that 1200 level did in fact hold, and it sold off about 175 points down to 1026.96, where it closed on the day that those options expired. So if right before 4 p.m. we closed the position, let's take a look at how the trade would have turned out. And the way that you close an options position is to reverse each transaction. So let's break this down. First off, we take into consideration that we've already received $12,868 when we entered the position, And here's where it gets interesting. You see, because Tesla has dropped in value so much down to 1026.96, the value of that 900 call has dropped tremendously also. Why? Well, think about it. If the owner of that call that we sold were to exercise that call right around the close on that day, then he would have received those shares, of course, for $900 per share. But this time, while he'll make a profit, he would only make the difference between the closing price of 1026.96 and the exercise price of 900, which is, in other words, $126.96 per share, and he'd own 100 shares. So if he flipped them immediately, he'd make a profit of $126.96 per share. So right before closing, those options only have that value, that $126.96 per share that you'd make if you flip those shares right after exercising. And so again, since you would in that scenario own 100 shares, the value of that option would be $12,696. And if you wanted to close that open short call option position, that's what you'd have to pay to do it. So you subtract that cost of closing the 900 call from the original cash flow. And you'll also notice that the 1200 call had zero value at that point because the shares closed so much lower than the 1200 price. And that option is expiring. And so that just disappears with no value. And so the final profit on the trade is $13,172. So if you think about it, the trade made money primarily because the 900 call lost so much value compared to what we received for it when we sold it, net of the original cost of that 1200 call when we entered the trade 4 days earlier. Okay, so that trade obviously worked out beautifully and we made money, but of course it could have gone the other way and Tesla could have gone up. So let's take a look at that scenario as well, because that's the losing scenario. And so let's say that Tesla had closed at 1300 on that Friday, which of course a stock like Tesla is absolutely capable of doing. Well, in that case then, to buy back that option would cost $400 per share or $40,000, right? Because now the owner of the 900 call that we sold can flip them and make a $400 profit per share on his 100 shares. But remember, at 1300, the 1200 call we own also has value, right? Because if we hold on to that call and exercise it and then flip the shares immediately, we would make $100 per share. So for 100 shares, that translates into $10,000 of value. And so adding that back in, you can see that the loss on that hypothetical trade is only $4,132. But what's interesting about this is if you think about it, at any price above 1200, the value of the 900 calls will always be $30,000 more than the value of the 1200 calls, because the value of the 1200 calls will increase dollar for dollar along with the 900 calls at any price above 1200. And so the net cost of buying back that 900 option and selling the 1200 option will never be any worse than $30,000, meaning the loss on the spread can never get any worse than the loss we saw here, which again is $4,132. Now, what's the best case scenario on the trade? Well, that's if Tesla had dropped to 900 or lower. Why? Well, think about it. Again, taking into consideration the positive cash flow at the beginning of the trade, we look at the value of the 900 call, which drops to zero if the stock closes at or below 900, because there's no point in executing a right to buy a stock for 900 when you can just go out and buy it in the market for 900 or less. And so that call, and of course the 1200 call, for the same reason, would both expire worthless. And you're just left with the $25,868 that you collected initially when you opened the trade. So the implications of this are pretty huge, right? Because what that means is that you made a bearish bet on Tesla, and your worst case scenario on the trade is 41.32, while your best case scenario is a gain of 25,868, which results in a 6.26 to 1 reward to risk ratio, an excellent risk reward that is locked in. The market can't gap through your stop because that long call at 1200, if you think about it, is your stop. And so what I'd like you to take away from today's video is that you can make a bearish trade on a stock like Tesla without outright selling the shares and taking that overnight risk of Tesla going crazy and rallying to the moon wrecking your account in the process. Instead, you can enter into a deep in the money call trade like the one we just shared with you, selling a call very deep in the money, collecting a huge premium for it, and then buying a call just out of the money for way less than you received for the call you sold. And so even if the stock goes up, it immediately activates the long call, limiting your loss, while if the stock goes down, the enormous premium that you received initially could evaporate, perhaps all of it in the best case scenario, making your reward to risk incredibly good versus the terrible risk of going in overnight short on Tesla, a stock that has no problem moving hundreds of points against you in a week. These are the kinds of creative uses of option strategies used by professional traders all the time. And now you have some insight into how pro traders control risk on stocks like Tesla that are dangerous on the one hand, but provide incredible potential for profit on the other. And so by controlling risk on the one end while allowing for a lot of profit potential on the other, you get the best of both worlds. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.